Most people think they know about money, but when it comes to managing it, and God forbid being tested on it, most people actually fail.
Americans are borrowing more than ever,
finding themselves sinking deeper into debt,
reporting higher delinquency rates,
making early retirement withdrawals, which financial advisors say never, ever do.
Bankruptcies are actually hitting their highest level since the Great Recession.
Personal bankruptcies are surging. Many borrowers are falling into a cycle of debt, often relying on new loans to pay off old ones.
And if you can answer correctly these 3 simple questions on financial literacy, you just might be ahead of most people. But I warn you, these are not as easy as you think. What's up, guys? This is your boy, Kenny Finance. Normally, I am a private equity ninja buying businesses, but today, I'm your financial literacy professor. And if you're new to the channel, welcome. I'm your host, Kenny, where I love talking about all things saving, investing, and doing smarter things with your dollars. So make sure you guys subscribe to the channel where you never miss a beat when it comes to smart money moves. And in today's video, we're going to be diving into number 1, talking about the big 3 financial literacy questions from the Global Financial Literacy Excellence Center. And look, this is a real governing body, and people actually use this test to see how many people are actually financially literate. So this is not like something I'm making up off the top of my head. And then 2, we're going to talk about how many people actually pass this test. And then 3, if you stay towards the end of this video, I'm going to give you guys some extra credit and see if you can pass Kenny Finance's Smart Money Move test as well. So let's dive in. Drum roll, please. Time for question number 1. This will be testing if you know how to make your money grow. All right, let's see. All right, first question. Suppose you had $100 in a savings account earning 2% interest per year. After 5 years, how much money would you have? And I'll give you 3 simple options. A, more than $102. B, exactly $102. Or C, less than $102. I'll give you 1 second to decide. All right, and if you answered A, more than $102, you are correct. And this question is testing if you understand the concept of compound interest. Now, that first year, you made $2 of interest, so you had $102, but the second, third, fourth, and fifth years also earn compound interest as well, so it is going to be more than $102. Next question. That was a little too easy for you. If your savings account earns an interest rate of 1%, but inflation is 2%, after a year, you can buy A, more than today, B, exactly the same as today, or C, less than today. Keep in mind, your savings earns 1%, but inflation, meaning the pace at which the price of goods is increasing, goes up by 2%. If you answered C, you are correct. Inflation simply means that your money loses value over time. And if inflation is growing, your purchasing power is decreasing, especially if your savings rate or investment return rate is lower than what inflation rate is today. And an interesting stat is, on average, inflation has been going up historically around 3%. That is why you're seeing the price of milk go up, fruit, gas, eggs, all kinds of things. It's largely due to inflation or maybe like one-off things like chicken flu that's going around that's causing egg prices to go absolutely nuts right now. All right, moving on to 3 because you are not dismissed yet. We are not done with class. Number 3, let's see if you can protect your money. True or false? A, being true, B, being false, or C, meaning you just don't know and you want to hit that like button down below. Buying a single stock is safer than buying a mutual fund. And a mutual fund is essentially a basket of stocks, which is very similar to an index fund as well. So do you think, true or false, buying a single stock, a single company, is safer than buying a basket of stocks in a mutual fund or an index fund? True or false? Boom, false. All right. Plain and simple. The best thing you can do if you want to get strong risk-adjusted returns is to invest regularly into diversified things like an index fund or mutual fund and hold it for the long term. If you are investing in one single security, you are betting all of your eggs on one basket. There could be things like earnings or management changes or some random press release that comes out and has your stock plummet 50% the next day. All right, so you want to make sure that you are diversified so that one decline in one particular stock does not drastically impact your overall investment portfolio. So my utmost recommendation all the time is to automatically diversify by buying index funds. And the beautiful thing about it is that index funds, say for example, the SPY, has generated on average a 10.5% return over the last 30, 40 years, which is insane. All right. And also single stock pickers on average do not beat an index fund. All right. So not only are you getting strong risk-adjusted returns, is you're beating the pros that think they can pick individual stocks. So save yourself the headache and just buy an index fund. I like SPY and just set it and forget it and just enjoy your life. Go make some peanut butter and jelly and go kiss your kids or something, all right? Handle your business. All right, those are the 3 questions from the Global Financial Literacy Excellence Center. You think those are pretty easy? Well, to me, yeah. But what's crazy is most people actually fail. The stat from the GFLEC, whatever their acronyms are, says that only 33% of Americans actually answered all 3 of those questions correctly, meaning that more than half of the United States fail this simple financial literacy test. That's a dang shame. They must not be watching Kenny Finance. But for some reason, I feel like you guys are a lot smarter than the rest of those cookies. So if you passed all those 3 correctly, you can move on to the extra credit session where we talk about Kenny Finance's Smart Money Moves test. All right, I'm not taking it easy on you guys, all right? It's getting real. Question 1, critical smart money moves. Select all that apply. This is not multiple choice. This is not true or false. You have to select all that apply as smart money move initiative that you need to be making with your dollars. Number 1 is getting out of debt. Number 2, investing in index funds. Number 3, investing in crypto, including Ethereum, Solana, Bitcoin. And number 4, establishing an emergency savings fund of 3 to 6 months of living expenses. Which of those apply? And multiple apply, but let me know which ones. If you said building an emergency savings fund of 3 to 6 months of living expenses, getting out of debt, and investing in index funds, you are correct. Crypto is cool. I admit. It's sexy, right? But it's dumb. I'll be very honest. There are no fundamentals. It is not going to give you a consistently good compounded return over the next 100 years. It's a tough spot, all right? So crypto does not have a role or place in the smart money moves rubric. I'm sorry. Hey, I'm putting it out there. Do I own some crypto? Yeah, maybe like 1% of my overall portfolio. But am I banking on it to build wealth for my family? Not really. It's just a fun thing to do. Next, this one's hard. Your stock falls 50% in one day. What do you do? A, sell immediately. B, if you have the cash, buy more. If you answered B, buy more, you are absolutely correct. And this concept is about your risk appetite and conviction in a really good investment. And I like to take Warren Buffett's approach. Warren Buffett says that he loves it and he's elated when stocks fall down because it means that quality businesses that he loves is essentially on sale and on the clearance rack so you can buy more of it at a cheaper price. And it's just like this. Say, for example, that you have a set of your favorite candy or your favorite groceries at your grocery store, and you go there one day, knowing you regularly buy it, you see it 50% off. It's not like you're not going to buy it. You are going to be inclined to purchase it, more of it. So think of it that way. If you have a good business that has strong fundamentals, good free cash flow, is growing, quality management team, and is moving up and to the right, but just so happens that one day because of crazy news or a competitor gets wiped out or something that's very temporary causes the stock to fall and plummet 50%, but the fundamentals remain unchanged in the business, that, my friends, is an incredible buying opportunity for you to buy more up of that particular stock. So if my stocks that I love, that I have conviction in, fall 50%, best believe I'm buying more. Moving on to number 3, assuming the fundamentals of a stock that you own remain unchanged, when is the right time to sell the stock? This one is hard. I personally failed this question probably like 17 times in my lifetime. All right, here are your options. A, after a 20% gain in 6 months. B, after a 20% loss in 6 months. Or C, never. And if you answered C, never, you are absolutely correct. The key to investing is invest early and hold for as long as you feasibly can. And if the business fundamentals have not changed and the quality of the company is still incredible, hold it forever. Unless the fundamentals change and if something is significantly overpriced, then you can consider selling. But if the fundamentals have not changed and the business is still attractive and it is still growing, just hold it. Because odds are you are going to be getting strong compounded returns long term. And the big money is not in the buying and selling, but Charlie Munger says the big money is actually in the waiting. So my philosophy is to never sell quality investments, and I intend to have my portfolio that I have now, which is really good index funds and good quality stocks. I intend to hold it forever. And then when I pass away, transfer it over to my kids so that they have no capital gains tax, instead have a step-up basis, and they can inherit all of my investable valuable and appreciated assets tax-free, and then they hold it forever, and they pass it to my grandkids, and they hold it forever, and the next thing you know, boom, the Kenny family is the richest of all time. Just kidding. I don't really care about being the richest of all time. What I care about is having strong financial freedom as well as an incredible portfolio that I can pass down to generations to generations. And the best way to do that is to give yourself enough time for long-term compounded growth and never sell quality stocks. All right, time for you to submit your test results. Scantrons need to be in ASAP. I want you to put down in the comments how many out of these 6 financial literacy questions you got correct. And it is okay. This is a judgment-free smart money community. I just want to see how financially literate this smart money community is. So drop in the comments if you got 1 out of 6, 2 out of 6, 4 out of 6, 6 out of 6, whatever it may be. Put it in the comments down below. And I think because you guys are amazing financial ninjas, I think that you all are likely going to be between the 3 to 6 out of 6 ballpark range for financial literacy. And that is okay, and that is really good. And I'm telling you, if you watch the rest of my videos, you will definitely be at the 6 out of 6. But I'm just curious right now what the pulse is for this classroom. Now, if you pass this test, the next phase is going to be understanding how to master the art of investing like a pro. So now I'm going to walk you guys through my 15 years of investment experience that I've had on Wall Street, working at places like KKR and Blackstone. I'm going to take everything that I learned on the street of how to invest professionally, and I'm going to show you guys how to begin your investing journey and start off on the right track like a pro. So check this out in this next video. Give me like 2 seconds. I'm going to run and get a quick snack, and then I'll be right back, and I'll catch you guys in the next one. Peace.